Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be going through 3 of the most attractive looking US dividend stocks on the market right now that you should consider adding to your portfolio. The first stock that we are going to look at today is Target, stock ticker TGT. Target Corporation is a major American retail chain that operates as a big box department store offering a wide range of products including groceries, clothing, electronics, home goods, and more. Its main aim is to bring value for money to consumers and offer discounts, online shopping, and same-day delivery services. Its main competitors are Walmart, Amazon, and Costco. As you can see on screen, their current price is $124.04. They're based in America, part of the consumer industry, have a market cap of $56.84 billion. They went public in 1967, have a massive 22-year dividend growth streak with a 5-year dividend growth rate at 10.82%. They also have a fairly nice yield, currently sitting at 3.61, and a very healthy payout ratio at only 46.7%. Analysts have mixed views on Target stock performance in 2025. The average price target is approximately $142.90, with estimates ranging from $103 to $170. As you can see on the graph, they're actually down 18.39% over the last 12 months. So with those analysts' expectations, the average price target is a lot higher than that current price, currently $124. Some analysts have recently adjusted their price targets. For instance, Guggenheim raised theirs from $145 to $155, reflecting confidence in the company's future performance. Despite a challenging third quarter in the previous fiscal year, where Target missed expectations on earnings per share, revenue, and comparable sales, the company experienced a strong holiday season with record performances during Black Friday and Cyber Monday, leading to a 1.5% increase in same-store sales. Target's commitment to digital expansion, store investments, and exclusive brand offerings positions it well for future growth. My only concern is that you need to consider the competitive retail landscape with brands like Amazon trying to make their mark on the market share. But they do have that long 22-year dividend growth streak. With the share price being down so much, it offers that yield now at over 3.6%, which is their highest ever. To back this up further, their 5-year dividend growth rate sits over 10%, which means they're all very impressive numbers, not only for a dividend-focused investor, but also for a dividend growth investor. If we have a look at the 12-month Wall Street estimate, we can see that the average analytic price is around that $147, and the high estimate price is around $220, with the low price being a 15% downside at $104. And then their intrinsic value currently sits at $164 for my base case scenario, which means they are undervalued currently by 25%. At their current price being at a 52-week low, I think this could be a great time to consider Target for your portfolio. The next stock we are going to look at for the month of March is Humana, stock ticker HUM. Humana Inc. is a leading American health insurance company specializing in Medicare Advance plans, Medicaid, and commercial health insurance. Humana is one of the largest providers of government-backed health plans in the US. Humana has recently been expanding its healthcare services, focusing on home health, primary care, and digital health solutions to improve patient care and lower costs to attract more customers. As you can see on screen, their current price is $270.42. They are obviously part of the healthcare industry, have a market cap of $32.56 billion. They went public in 1968, have a 13-year dividend growth streak, have a 5-year dividend growth rate at 9.98%, a slightly lower yield at 1.31%, but also a very low payout ratio, currently at only 32%. As you can see from the graph, they're down 23.18% over the last 12 months, and there are many reasons why I see Humana as a good choice for your portfolio in March 2025. First off, they have a strong market position in Medicare Advantage. This is a rapidly growing segment due to the aging US population. Medicare Advantage enrollment is expected to keep expanding, which will only benefit Humana's long-term revenue. Humana has shown good revenue growth and strong fundamentals, highlighted by their revenue growth in Q4 2024, as it grew 10% year over year to $29.21 billion. Despite some setbacks, Humana remains a profitable company with strong cash flow position. There have been rumours of a possible acquisition by Cigna, which could drive the stock price higher if a deal is confirmed. A merger could create one of the largest health insurers in the US, improving competitive positioning. Humana has been hit by short-term Medicare Advantage enrollment declines, but this is likely a temporary issue. Analysts still expect steady earnings growth beyond 2025 as Humana adjusts its business strategy. And Humana's stock has underperformed recently, making it cheaper relative to earnings and revenue growth compared to rivals like United Health Group UNH and CVS Health, stock ticker CVS. If the company successfully turns around its Medicare enrollment issues, there could be strong upside potential. If we have a little look at their 12-month Wall Street estimates, you can see on the worst case they see it as a 9% downside in that current price at $243. But on the average and highest case forecast, they believe it could be an 11% upside and a massive 66% upside on that current price. To back this up further, when plugging in my numbers for their intrinsic value, on the base case, Humana was seen at being undervalued by a whopping 52%. I love to see a 10% 5-year CAGR with a low payout ratio, only 31%, so still loads of room to keep it growing, coupled with the 13 years of consistent growth. Remember that the healthcare sector is very recession-proof, one which will in turn only benefit Humana if there is uncertain economic conditions. So if you believe in the long-term growth of Medicare Advantage, home healthcare and value-based care, Humana could be a strong buy at its current valuation. Finally, we've got the United Parcel Service, stock ticker UPS. United Parcel Service is one of the largest logistics and package delivery companies in the world. Headquartered in Atlanta, Georgia, UPS operates in over 220 countries in the world, providing shipping, freight, and supply chain solutions. They handle millions of shipments daily for businesses and consumers that are known for moving large shipments globally. They work closely with retailers to provide fast and reliable shipping, including same-day and next-day delivery. And the UPS access point locations allow customers to pick up and drop off packages at stores. UPS is a critical part of the global supply chain, supporting industrials like e-commerce, healthcare, and manufacturing. Their current price is $119.03. They're part of the industrials industry, have a market cap of $87.05 billion. They went public in 1999, have a 15-year dividend growth streak, also have a very nice 5-year dividend growth rate at over 10%, with a massive yield being the biggest out of the three of them at 5.51%, but their payout ratio is on the slightly high side currently at 95%. You can see the stock performance over the last 12 months being down 19.61%. But in 2024, UPS reported annual revenues of $91.07 billion, which was actually a slight increase from the previous year. Despite challenges, the company is implementing strategies to enhance profitability. In Q4 2024, UPS reported consolidated revenues of $25.3 billion, which was a 1.5% increase from the same period in 2023. Additionally, the potential end of the freight recession could benefit UPS, with analysts suggesting that dynamic pricing and cost cutting. Recently, UPS announced plans to reduce its volume of Amazon packages by half by June 2026. This is one way they aim to focus on higher margin shipments and improve profitability. This was backed up by UPS analysts who suggest that UPS can offset potential revenue losses from reduced Amazon volumes through the higher margin shipments, but also through cost-cutting measures and facility closures. If we have a little closer look at their 12-month Wall Street estimate, we can see on the lowest estimate they believe that there could be up to a 30% downside on that current price, but with the average and highest case estimates, they believe there could be a 14 and 59% upside on that current price. To back this up as well, their intrinsic value when I plugged in my numbers on the base case was a 20% undervaluation, being valued at $147.90. This is another stock with above a 10% 5-year dividend growth rate, but this stock also boasts a massive yield at over 5.5%, so you will be receiving some big dividends on a quarterly basis. Not only that, the 15-year dividend growth streak means that you can have some level of confidence that this dividend will continue to be paid at an increased rate. Is this a stock you think to add to your portfolio, or do you potentially already own UPS in your portfolio? Let me know in the comment section down below. Thanks for watching. If you're building a portfolio of passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. Until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.